Tesla stock is down 14% year to date, and in this video, I am going to do an in-depth analysis by looking at the financials of the company, the balance sheet, and using my Excel spreadsheet to calculate the intrinsic value of the company. Starting with the financials, Tesla has grown revenue from $12 billion in 2018 to $95 billion currently, which is a 48% annual revenue growth average. In this regard, analysts are expecting them to grow at an average of 21% for the next 6 years. The Cybertruck is launching this year, and assuming it captures 10% of this market, this would add roughly $20 billion in annual revenue for Tesla, which is 25% of the current revenue. Moreover, the EV market is expected to grow at a compounded annual growth rate of 13% for the next 7 years. Therefore, I think analysts might be a little bit conservative. Regarding profit, their margins have suffered recently. Profit margin going from 15 to 11% and free cash flow margin from 11 to 3%. This is due to aggressive price cuts and increased spending on the Cybertruck. These are temporary issues, and in the long term, their margins could be a lot higher if they manage to become more of a software company, which right now they are not, as 80% of their revenue comes from selling cars. In this regard, analysts are expecting them to make $8.09 in 2028. If you assign a 25p to the company, it would make it a $202 stock in 2028, meaning minus 5% returns. Then, in order to calculate the intrinsic value of the company, I used my Excel spreadsheet, which tells me at what price you should buy your stock based on the assumptions about the future of the company that you put in. I did a 7-year analysis with low, middle, and high assumptions. Right now, you are seeing 6 numbers. The top 3 are based on net income and the bottom 3 on free cash flow. The free cash flow numbers are a bit lower because historically, they have averaged less free cash flow than net income. These numbers mean 2 things. First, that in order to make the desired annual return that I have put in, which is 12%, you need to pay these prices. I went with 12% because you can get around 9% investing in an ETF. Therefore, if you take the risk of investing in an individual stock, you should desire a higher return. Second, if the low assumptions occur, you are going to make a negative 7% annual return on your money. Middle, positive 6%, and high 20%. The stock is a buy only according to my high assumptions, in which I consider Tesla as a software company with 16% margins. I also assumed 28% annual revenue growth, and I assigned a 23p and price to free cash flow, which are the multiples that I think the company is going to sell for in 7 years, not now. On my low assumptions, I consider Tesla as a car company with 6 to 8% margins. For example, Toyota has 9% profit margin and Honda 5%. I left the share outstanding change at 0%, but they have been issuing shares for the past 10 years. This is very hurtful for investors as you are owning less of the company. This also tells me that the management thinks the stock is overpriced because if they thought it was cheap, they would be buying back shares. And if you consider an increase in the number of shares outstanding, the intrinsic value would be lower, as you can see with the assumptions they issue 2% of their shares each year. Regarding the balance sheet, it is exceptional as they have $26 billion in cash and only 4 in debt, which is very little debt for a company that has a market cap of $673 billion. The pros of investing in this company are that it is a growth company, the balance sheet is amazing, and I believe it is a moat. The cons are that they are issuing shares and that the valuation is expensive. The price to sales ratio is a good metric to compare companies within an industry. If we compare it to other car companies, it's very expensive, as Tesla is trading at a price to sales of 7 and other car companies trade at a price to sales of less than 1. But comparing it to other tech companies, it looks like it's trading at a fair valuation. Google is trading at a price to sales of 6 and Meta at a price to sales of 7. In conclusion, I think Tesla is a fantastic company, but that is trading at an expensive valuation. However, if you believe that they are going to transition into a software company, this could be a great investment. I hope you enjoyed the video. Let me know what you think about Tesla in the comments, and I'll see you in the next one.